When investors want to ring-fence assets, the traditional approach is to hold each asset in a separate SPV. This works in principle, but it increases cost, create multiple entities to manage, and add separate regulatory and administrative requirement for each SPV structure. Over time, this becomes inefficient. Each SPV requires its own maintenance, governance, and banking relationship, even when assets are part of the same overall investment strategy. To address this, DIFC has introduced the Variable Capital Company. It is a single legal entity where you can create multiple cells underneath it, and each cell can ring-fence assets independently without needing a separate company. My name is Shiraz Wahid and I'm the co-founder at Lepidus Wealth, and in this video I'm going to explain how to set up a variable capital company in DIFC, how this structure works in depth, how it is used in real case scenarios, and what the regulatory process involves, and how to design it correctly as part of a broader wealth or investment structure. Before going into the setup process, it is important to understand the concept properly, because VCC is not a traditional company and it is not a fund manager. It is a flexible asset holding and structuring vehicle. A variable capital company or VCC is a corporate structure where share capital is directly linked to the net asset value. This means the value of shares adjusts continuously based on the underlying asset held within the structure. Investors can enter and exit through subscriptions and redemptions based on net asset value, and distributions can be made from capital rather than only from realized profits. In practical terms, the structure behaves more like an investment vehicle, but legally it remains a corporate entity used for holding and structuring assets. A DIFC VCC can operate either with segregated cells or incorporated cell, but not both at the same time. Segregated cells are compartments within the same legal entity. They ring-fence assets and liabilities but do not create a separate legal person. Incorporated cells are separate legal companies under the VCC. Each incorporated cell owns its own assets, can contract in its own name, and can be separated or transferred independently. The choice between the two depends on the level of legal separation, future flexibility, and the complexity of the structure. The VCC itself does not carry out regulated financial services such as fund management, advisory, or arranging deals. It operates purely as an asset holding and structuring platform, and any regulated activity must sit at the manager or platform level outside the VCC. This distinction is important because the VCC creates structures and segregation, while regulated control sits with licensed entities. A VCC operates with variable capital linked to net asset value or NAV, allowing shares to be issued, redeemed, or adjusted without traditional capital maintenance procedures. Redemptions are based on the net asset value, and distributions can be made as long as the structure remains solvent and the NAV remains positive. This removes many of the constraints that exist in traditional companies where capital is fixed and changes requires formal legal processes. The use cases for a VCC are broad. It can be used for family office platforms where different family members invest across separate strategies, or property portfolios where each asset sits in its own cell, for intellectual property holding, private equity continuation structures, aircraft or yacht ownership, and structured financing arrangements. It is also used in crowdfunding or deal-by-deal investment structures, where each opportunity is isolated within a separated cell. A VCC cannot employ staff, and all operations must be outsourced. A DIFC corporate service provider must be appointed to handle administration, governance, and statutory requirements unless the structure qualifies as an exempt VCC. This includes maintaining records, managing filings, and supporting compliance requirements. And the structure is designed as a pure holding vehicle with centralized accounting, NAV calculations, and reporting across cells. The VCC must maintain proper records, including a share register and sub-registers reflecting beneficial ownership. Assets and liabilities must be clearly allocated to each cell, and NAV must be accurately calculated based on those allocations. The structure must also clearly disclose when transactions are carried out, specifically which cell is involved as part of the governance framework that supports creditors. VCC is incorporated through the DIFC register as a holding company structure and can be established directly as a VCC or by converting an existing DIFC company into a VCC. The Article of Associations must clearly define whether the structure uses segregated or incorporated cells and how capital, governance, and cell operations are managed. Once established, the VCC must open bank accounts and become operational, and banks will review the structure in detail, including ownership, governance, and how cells are used. Clear documentation is essential, especially where multiple investors or cross-border assets are involved. One of the key features of a VCC is strong ring fencing of liabilities, where creditors are limited to assets of the specific cell they are dealing with, and they do not have access to other cells or the wider VCC. Directors must clearly disclose the relevant cell in transactions, and if this is not done properly, it can create liability exposure. The VCC framework allows restructuring, including transfers of assets between cells, merger of cells, and conversion between segregated and incorporated cell structures. These actions require formal procedures, including notice to creditors, approvals, and regulatory filings, and the structure can also be converted into a standard company, or it can be redomiciled to another jurisdiction if required. A VCC does not remove tax automatically, and tax treatment depends on investor residency, domicile, and jurisdictions involved. In some cases, segregated cells may be treated as a single entity for tax purposes, while incorporated cells may require separate filings, which means the structure must be aligned with broader tax and ownership planning. A VCC is one layer within a broader framework where a foundation or holding structure may sit above the VCC to manage ownership and succession, while the VCC handles asset segregation and capital deployment. This allows separation between ownership, control, and investment activity, and ultimately, the VCC provides a structured and efficient alternative to multiple SPVs with built-in flexibility, segregation, and governance, but it must be designed correctly to work as intended. Now, if you would like our help and would like to explore whether a VCC along with a foundation or a trust can suit your situation, you can request a personalized asset protection plan by clicking the link in the description below.